What in the world do zombie mortgages mean? An opinion audio article written and produced by Pierre Anthony and narrated by me, Andrew. Some people may think, oh yes, I know what it is, while others might say, what are you talking about? Zombie mortgages are home loans that were foreclosed upon by banks, but the foreclosure process was never completed. In some cases, the occupant and owner remain in the house to hear the outcome of the foreclosure process, but the news never comes. The term zombie mortgages is a metaphorical expression naturally and does not refer to Hollywood zombies. The problem is that in cases of zombie mortgages, the process is abandoned due to financial or logistical challenges. It does happen that the owners are not informed about it and find themselves with bigger problems. Homeowners may still technically own the property and remain responsible for its upkeep, property taxes, and other liabilities. For a moment, imagine buying that first property. All goes well for some time, and suddenly calamity. When excitement turns to horror and you inform the bank, and as banks are, they do not care. You try to sell, but nobody is buying. The bank foreclosed and now you feel down, and you do not feel like contacting the bank to find out what the status is of the foreclosure process. You already feel embarrassed, the world is tumbling in around you, and a couple of months later, you get in trouble for outstanding liabilities. Angrily, you inquire about the newly added trouble, and you find out that you thought the liability for the property has shifted to the bank. But no, you are still the legal property owner. A mortgage is a loan used to purchase real estate, where the property itself serves as collateral for the loan, and when the loan cannot be serviced, the property reverts to the bank through a legal process. Nevertheless, the current owner remains liable for any costs incurred. So if it is the purchaser or the bank, liability remains. But what can you do when facing foreclosure due to unforeseen circumstances? Well, you can sell the property to service the loan, and that way you can avoid foreclosure and a bad credit score. But if the scenario is a loss of one income in the household, not all income, then a loan modification could help by negotiating a change in the terms of the mortgage, such as the interest rate, monthly payment amount, or loan term. At least you can keep the property and avoid foreclosure. Refinancing is an option by taking out a new loan, maybe at a different institution, to replace the existing mortgage, ideally with better terms. Securing lower interest rates or a manageable payment plan could make it easier to stay current. Another arrangement could be the voluntary transfer of ownership to the lender for release from the mortgage obligation. Another option is filing for bankruptcy, which can offer temporary relief. Chapter 13 bankruptcy allows for the reorganization of debts and create a repayment plan, while Chapter 7 can release certain debts. Chapter 7 bankruptcy hurts your credit score and remains on your credit report for up to 10 years, and not everyone qualifies for Chapter 7 bankruptcy. Chapter 7 could release some of your unsecured debts, but may not prevent the loss of your property. The bankruptcy trustee may sell non-exempt assets to pay creditors, which could include your home if it is not protected by a homestead exemption. There are other alternatives like forbearance agreements, repayment plans, and various government programs, but most importantly, if you see difficulty through some other pending calamity, go and speak to the bank immediately, without delay, or a housing counselor. It is far better to have a plan in place if you need it because you are proactive than having to face trouble when it is almost too late. A good example is if a spouse loses a job, and if you have forewarning, like the business is not working well, then you should approach the bank, describing the pending problem. If the business suddenly turns around and does better, and could avoid retrenchments, then rather go back to the bank red-faced. For being proactive, rather than going to the bank red-faced with the news that you are already in deep trouble. Putting it in other words, do not be an economic hypochondriac, and every time there is an economic hiccup, run around screaming with hands waving in the air, but be mindful, be proactive if possible, and do not ignore debt. Always think, research, and act as soon as possible. Procrastinating does not always solve the problem, and sometimes being proactive does not solve the problem, but at the very least, you can keep your head high and say, I have done what I could.